Really common question is, Martin, how do we access equity to actually start the process of building out a real estate portfolio? Here you have your principal place of residence. Let's just call that $1 million. And say you have a home loan of 600 grand. So typically speaking, the bank will lend you up to 80% of the value of your home. So in this case, you got $1 million, they'll give you up to $800,000. You already owe 600. So they'll give you another facility here of $200,000, which we set up as interest only, and you only pay on that money once it's used. So you have a separate $600,000 home for your house, $200,000 to use as your deposit and closing costs for your investment property. So let's then say you come across here, you found your first investment, and it's going to cost you $600,000 to buy. So what we do, we don't want to cross-secure the properties. We use the $200,000 you've accessed here to pay a 20% deposit, $120,000, plus closing costs. Let's just call it 30 grand for this example. So you're going to use $150,000 of the 200 to deposit over here. You end up with a mortgage over here of $480,000. Typically speaking, you're going to have all your investment facilities interest only to save on cash flow, because there's no tax deductions for paying the principal off. So you always want to focus on paying the 600 off first. But that is how you get started in building out your real estate portfolio. You access the equity up to 80% of the value of your principal place of residence and use that to secure other assets.